In this week's video, we'll take an in-depth look at investing within the context of global central planners and their Kale Smoothie economy. We'll take an in-depth look at global debt, helicopter money, and the Fed, and answer the questions: how did we get here, and what does it mean for the markets and investing? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Taking a look at the big picture can help us make better investment decisions, and under our system, we use price to guide us, but we also need to understand what price is telling us to have the conviction necessary to execute properly. We'll walk through what a healthy economy looks like, how bonds and debt enter the equation, interest rates and how they impact decision making, past, present, and future from a central bank perspective, bailouts, the Kale Smoothie economy, helicopter mania. How does all that impact the markets and investing? We'll talk a little bit about how the Fed is trying to engineer a bottom from a top and discuss bull-bear scenarios. In the context of a healthy global economy, the Fed uses interest rates to implement monetary policy. Their transmission mechanism is banks. Banks, of course, loan money to businesses and households. There's a negative that comes along with that. Debt starts to pile up, but there's also a positive that can come along with loans and credit. Borrowed money can help fuel consumption, and it can assist businesses in terms of investing in plant, property, and equipment. Capital expenditures and consumption from consumers can help keep the economy on track and can also help keep the unemployment rate at reasonable levels. While it may seem like a distant memory, the Fed's statutory mandates, they have a dual mandate. They're supposed to engineer full employment if possible within the context of price stability. If we read from the traditional Fed script, they typically lower interest rates to try to stimulate and to meet that objective of full employment. And when inflation starts to pick up, the Fed's traditional playbook says it's time to raise interest rates. It's also helpful for us to understand the basic functions of the free capital markets. Businesses can also raise capital from households. What does a household get out of it? Well, they get interest payments along the way while they're holding the bond, and if everything goes well at the end of the agreement, they get all of their principal back. But the household, there's no free lunch here. They do assume some risk. If the business is not functioning well or is not managed well, that risk will increase, and typically that risk is reflected in the bond market as the bonds start to sell off. The biggest risk that bondholders assume is a bankruptcy that could lead to a bond default. And under that scenario, that's the free market's way of telling us that the capital raised by the business was not used in a particularly efficient manner, leading to a bond default. All of this sounds really, really harsh. However, there are benefits. When weaker sisters are weeded out of the system and bad debt is purged from the system via bankruptcies and defaults, what's left is the productive and serviceable debt, allowing the economy to function in a healthy and productive manner. Now let's take a closer look at the impact Fed policy has on decision-making in the economy. A hurdle rate is a capital budgeting term that speaks to sound decision-making and efficiency. For example, if banks are offering loans at 8% and we're going to take out a loan from a business perspective, we know that whatever we do with the proceeds from that loan, the investment that we make, must produce a return of at least 8% or we're going to lose money. As the Fed starts to lower interest rates, those hurdles start to fall as well. At a 4% rate, now my investment only has to produce a 4% return to break even. The more aggressive central banks get with those policies, the lower the hurdles for taking out loans. So hypothetically, if we're into a negative rate environment and I could get a loan at a negative 2% interest rate, which basically says that I pay back less than what I borrowed, now my hurdle rate is extremely low. Now I don't have to make money. I just have to make sure that I don't lose more than 2%. Compare and contrast that with what has to happen when interest rates are at 8%. The investment that I make with the loan has to produce at least an 8% return. It's quite a bit more difficult than making sure that I don't lose more than 2%. Therefore, when the Fed or any central bank around the world starts to play around with interest rates, there are positives that come from that, and there are also negatives. The higher the hurdle rate, the more creative I have to be. I have to come up with a good idea to take out a loan at 8% and expect to be profitable. Therefore, higher hurdle rates call for innovation. You have to think long and hard before you take out a loan at 8%. And typically, when creativity and innovation are in the equation, the investment that we make with the proceeds from that loan, they tend to be quite a bit more productive. Conversely, while I had to think long and hard before taking a loan out at 8%, if I'm going to pay back less than what I borrow and money is basically free, or they're paying me to borrow money, the attitude might be, well, if they're giving out loans at that rate, let's take something and see what we can do. We don't have to be particularly creative, and we really don't have to innovate. Therefore, the type of project that's taken on the lower end of the spectrum tends to produce much lower productivity figures. In a strong economy where the demand for money is higher, interest rates are higher. That's the market's way of saying the supply and demand balance for loans. There's a lot of demand relative to the supply, and banks can charge a high rate. Typically, that occurs in a strong economy. When interest rates are negative, that's not a good sign. That's telling us that the supply of potential credit is much, much greater than the demand for that credit. Hurdle rates and interest rates also have broader implications in terms of the wider economy. Projects that score high on the creativity and innovation scale typically produce strong job growth. When employees and workers are more productive, they also tend to be happier. Conversely, when we're down on the bottom end of this scale, in the red area, projects that are based on low levels of creativity and low levels of innovation typically produce tepid job growth. These type of projects also tend to be less productive, which also impacts worker and employee satisfaction. Therefore, when the economy is strong and interest rates are higher, we typically get productive and serviceable debt in the economy. It's debt backed by well thought out and good ideas. When we move to the lower end of the spectrum and rates are at zero or negative, we tend to produce unproductive and non-serviceable debt. To give us a little bit better visual about how the law of diminishing returns applies to Fed policy, let's assume that the economy is relatively healthy and interest rates are at 8%, and the economy begins to weaken a bit. The Fed can lower interest rates in an effort to stimulate consumption and capital investment. When interest rates are still relatively high and the economy is still relatively healthy, the debt that you're adding to the system tends to be fairly productive and stimulative. And when rates are relatively high, the Fed's transmission mechanism for policy is working well. As the Fed gets more aggressive with rates, you start to add less and less productive debt to the system. And it tends to be non-serviceable debt, a larger percentage of it. And as the debt starts to pile up, businesses and households start to shy away from taking out additional loans, and the Fed's mechanism for stimulation starts to break down. In a healthier scenario, an interest rate move from 8% to 7% most likely would be a lot more stimulative than a move from 25 basis points to 0. In many European countries, we're under the zero bound and we're into negative interest rate territory, which says if I borrow $100,000, I actually pay back less than $100,000. And as you might imagine, that leads to even more debt, and that debt tends to be even less productive than the prior loans that were taken out. With interest rates basically at zero in the United States and in negative territory in many countries around the world, just how much debt has been accumulated? The answer, according to the Los Angeles Times, is the amount of debt in the system is shockingly high. World debt currently is far above 2008 levels. Total government debt since 2008, it's doubled. If we add up all the debt in the system, it increased a whopping 40% between 2007 and mid-2014. Therefore, if we thought the economy was vulnerable and over-indebted in 2007 and 2008, the problem is much, much worse today. With all of that debt in the system, it becomes very, very difficult to have businesses and households take out additional loans, which means investment in plant, property, and equipment, and consumption starts to suffer. As a result, economic growth suffers. We get tepid economic growth and tepid or weak job creation, which is why we often hear think tanks say that the transmission mechanism for interest rate policy and for central banks is broken. That may be true, but you can counter with their own policies are what broke the transmission mechanism. Taking a closer look at Fed policy during this economic expansion and the current bull market, when interest rates are at zero and debt levels are high, and you have that broken transmission mechanism, you really don't have much flexibility to alter interest rates anymore, so the Fed shifted to what's known as quantitative easing. The transmission mechanism is still banks, or at least that's what we hear. How it works: the Fed forwards electronic cash to the banks in exchange for U.S. government securities. The hope is that the banks, looking for a return on that cash, will use it to invest in stocks and bonds and help prop up the markets. If it seems difficult to believe that the Fed would try to prop up the financial markets in such a direct manner, when we really understand and look behind the term bank, it becomes a little bit easier to comprehend. We're not really talking about traditional banks here. We're talking about the 23 primary dealers. And they're the primary dealers in government bonds, and they help the Fed implement policy, normal interest rate policy, and QE. Here's a list of the current primary dealers. Currently, there are 23 of them. The source of this list is the Federal Reserve Bank of New York, right off of their website. When we look at the list and see that we've got Citigroup, Goldman Sachs, JP Morgan, Merrill Lynch, Morgan Stanley, and Wells Fargo Securities, we start to see that these are really broker-dealers rather than what we would consider to be a traditional bank, meaning it's very, very easy for them to take the cash that they just received from the Fed and turn around and invest it in stocks and bonds. When we look a little bit deeper into the list of the primary dealers, we also see that they have a global reach, meaning when the Fed enacts QE, that cash is making its way into the system all over the globe. So under this context, when we're talking about banks, we're really talking about the 23 primary dealers that help the Fed keep asset prices elevated. The thinking is when asset markets and asset prices rise, that households will feel better. This is what's known as the wealth effect. They're hoping that that will lead to additional consumption and help the economy and help create jobs. However, this policy also is subject to the law of diminishing returns. You can only prop up the financial markets so far, and then you start to run into problems with valuations. Just like lowering interest rates from 8 to 7% is more effective than lowering them from 1 to 0%, when you get to QE3, it's not nearly as effective as QE1 was, and consequently, when valuations get high, asset prices can start to become unstable again. And then you get somewhat of a reverse wealth effect if the central banks allow asset prices to fall. So like interest rate policy, quantitative easing has its limits. This is basically the picture the Fed was looking at in late 2015 and early 2016 when they were talking about raising interest rates. The financial markets became extremely volatile, and rather than having a positive wealth effect, we went into a negative wealth effect that hurt rather than assisted consumption and economic growth and job creation. Given the present-day economic profile, it's easy to understand, right, wrong, or indifferent, why central planners are very, very leery about letting bankruptcies occur or allowing large bond defaults to occur. Their fear is that we will see somewhat of a cascading effect similar to what occurred early in 2016, where if a company or a large bank is allowed to fail or they default on their bonds, that could start sell-offs in the public markets, and it would be very, very difficult to stop when interest rates are already at zero. Which is why, right, wrong, or indifferent, the term bailout is something that we're all familiar with. On paper, bailouts can sound good. We can protect the bondholders and we can protect jobs by not allowing large firms to declare bankruptcy and not allowing large and widespread bond defaults. Again, that sounds great. However, when central planners do not allow large bond defaults, indirectly, the problems that they're concerned about, they're making them worse. Bailouts keep unproductive and non-serviceable debt in the economy. So not only is the debt burden growing because you don't allow them to default, but the debt that you keep in the system is basically dangerous and vulnerable debt. Let's compare and contrast the upper right-hand corner of this image, unproductive and non-serviceable debt, with the productive and serviceable debt that's left behind when bankruptcies and bond defaults occur in somewhat of a natural selection process. Like many systems in nature, financial markets from time to time need healthy and productive and painful events such as bankruptcies, bond defaults, and recessions. Which brings us to global central planners and their Kale Smoothie economy. Let's assume somebody said, I've had it and I've decided once and for all that I'm going to get in shape and I'm going to stay in shape. One possible approach is to exercise regularly, and after you finish exercising, after you've done the hard and painful and productive work, you drink a kale smoothie. There's nothing wrong with a kale smoothie, but you're not going to get in shape by drinking kale smoothies alone. Method 2 is a lot less painful and, as you might guess, a lot less effective. Under Method 2, we just skip the painful exercise and hard work, and we simply drink the kale smoothies. In the world of central planners, the kale smoothies are interest rate cuts, quantitative easing, bailouts, helicopter money, debt, etc. The kale smoothie approach to global central planning avoids the healthy and productive pain, which would include recessions, bond defaults, bankruptcies, and actually allowing people to save money rather than trying to rely on credit, borrowing, and a continuous stream of loans. Which brings us to the present day. Rate cuts, bailouts, and a lot of debt in the system has not created sustainable growth, and it has not created happy and productive workers around the globe. Nor has it resulted in productive and serviceable debt around the globe. The trend recently has been when global central bankers take one policy tool about as far as it can go, they move on to the next policy tool, and that policy tool tends to be less effective than the prior policy tool. Example, interest rates, 8%. As we move down to negative rates, that type of transmission mechanism becomes less and less effective. Once that was taken to its logical conclusion, quantitative easing was brought into the picture, and in most cases, that is nearing its logical conclusion. The longer this goes on and the further it's taken, the more unproductive the debt becomes that's being added to the system. Central bankers have been hoping that if they lower interest rates one more time or make them negative or print some more money and buy assets, that growth will pick up. That's what they want to have happen. They would like to hand off the baton from these non-traditional and somewhat controversial policies. They'd like to hand that baton to the economy, and they would prefer to step aside. If growth picks up, it's possible that we're nearing the end of all these non-traditional policies from central banks. However, if growth doesn't pick up and they're faced with this type of look similar to what we saw in early 2016, central planners are still terrified of having that deflationary spiral take place, something similar to what happened in Japan. Once asset prices start to fall, it's very, very difficult to stop that, especially when you've shot numerous bullets from your policy holster. Under this scenario where growth does not pick up, central banks and central planners will be looking to reverse that look. They will want to prop up asset prices and make sure that things don't get away from them. In the United States, if the Fed wanted to stimulate again, it's likely that they would revert back to quantitative easing and they would not move directly to what's known as helicopter money. However, overseas, given the traditional mechanisms of interest rate policy and working through banks, those avenues have already been explored. It's possible that central banks will start making direct payments to businesses and households, ultimately just passing the middleman or the banks or the primary dealers if we were talking about the United States. Hypothetically, if the Fed used a policy like this, they might send checks in the mail out to every business in the United States and every household. The thought process is that that would stimulate spending or investment in plant, property, and equipment, and it would incent households to consume more. The ultimate goal of all of these policies is to create sustainable and lasting economic growth and to keep unemployment at reasonable levels. While it can take alternate and similar forms, direct payments from a central bank to businesses and households is known as helicopter money. The thought being that it's not that much different than having Janet Yellen get up in a helicopter and start throwing freshly printed money out of the helicopter to stimulate. On paper and from a stimulative perspective, that all sounds somewhat logical. However, we have to consider the context of when the helicopter money would come. It's after you've exhausted traditional interest rate policy and you're already at a point in Europe where you're actually paying people to take out loans. Those loans typically would be chasing very unproductive projects, and hence you're creating non-serviceable debt. The fact that interest rates are at zero or negative in some countries tells us again that relative to the supply of money, the demand for money is incredibly low. Therefore, when you send checks out in the mail, of course, that money would be spent or invested in some way, but we're already at a point where spending and investment at these levels and at this point of the policy process tends to be unproductive. And from a business perspective, unproductive spending can basically lead to overcapacity. And when you have overcapacity, your pricing power is destroyed. And that actually is deflationary, which is basically what central banks are trying to avoid. We also know that sending checks out in the mail could lead to serious misallocation of resources, and we've seen that already with policy blunders where the Fed kept rates too low for too long. The dot-com bubble, the housing bubble, and more recently the ability to borrow at near zero interest led to significant production of overcapacity in the oil business, which destroyed their pricing power. Another example of resource misallocation. Another huge concern globally is the debt burden of governments. It's possible that helicopter money could be used basically to retire government debt. Conceptually, this could also help banks, since many banks own government debt, with the hope being that if you pay off some of the government debt, that it would lead to economic growth and job creation. It might be sold in this manner. Helicopter money will allow for a debt reset, and we will learn from our mistakes, and we won't make the same mistakes again. If you've been around, that sounds awfully familiar. TARP, or the Troubled Asset Relief Program, was a massive bailout program in the United States. It was sold under this premise. TARP will allow the system to reset, and we will learn from our mistakes, and we won't make the same mistakes again. Well, it's been a few years since TARP. Have we made the same mistakes again, or did we learn from our mistakes? This graphic is from the Los Angeles Times, and the top of the graphic says, total debt of governments worldwide has doubled since the financial crisis began in 2007. Does not sound like we use TARP or any type of reset to learn from our mistakes. In fact, we've basically doubled down on the same debt mistakes. You can find the article about debt from the LA Times by Googling this title. If global growth doesn't pick up soon, we probably will be hearing the term helicopter money a lot more frequently in the months and years ahead. However, we have to keep in mind that helicopter money is on the bottom portion of this type of diminishing return image. The hope has been from central planners that if they implement one more stimulative policy, that they can stimulate their way to growth. Unfortunately, the other policies have not been effective. If helicopter money is used, the jury is out in terms of its possible effectiveness. A fair question might be, if helicopter money is the solution, or just sending checks out in the mail to everybody, we might ask, why do we bother getting out of bed in the morning if it's that simple? Common economic sense also tells us that helicopter money fits nicely into the Kale Smoothie list. If there was ever a policy that skipped the painful exercise and hard work, it would be helicopter money. In 2016, if the little voice inside our head said, what is going on, and why has the Fed flip-flopped from 4 interest rate hikes possibly in 2016, and a few months later they're talking about that they should have helicopter money in their toolkit? The simple answer is debt, or too much debt. A significant increase from the amount of overstretched and troubling debt that was in the system in 2007 before the financial crisis. Thus, in early 2016, understanding these figures and seeing what appears to be a multiple year topping pattern in the S&P 500 as of January 15th of 2016, and also within the context of slowing earnings growth and what USA Today termed as crazy valuations for some large stocks on January 14th. The Fed decided it was just too risky to stay with the traditional late economic cycle script where they try to raise interest rates as the economic data improves. In terms of their dual mandate, full employment and price stability, they should be raising rates now. But the other issues and the enormous amount of debt in the system, coupled with high valuations, makes it very, very difficult for them to follow the traditional late cycle script. So how can all this help us, and how does all of this translate to the asset markets in July of 2016? The S&P 500 just broke out of a multiple year consolidation pattern. Typically that's bullish. The longer the breakout holds, the more relevant it becomes. The breakout occurred basically 1 week ago. This obviously has bullish implications. However, when we look at some other charts, the market still seems to be concerned. The good news is we should get some better information relatively soon. Given all of the problems globally that we just covered, especially with the thought of helicopter money coming down the pike, it's relatively easy to understand from a currency debasement perspective or a fear of the system breaking down why, even after the S&P 500 broke out of a multiple year consolidation pattern, its chart relative to gold is still clearly in a downtrend that favors gold. We'll learn something either way here. If the S&P 500 can break out relative to gold, then this breakout starts to become a lot more meaningful and believable, especially from an opportunity cost perspective. A similar situation with silver. This is the S&P 500 relative to silver. These charts are the exact same time frame. So while the S&P 500 was bottoming here and moving on to a new high, this ratio was falling, telling us that silver has been significantly outperforming the S&P 500. However, even if silver is a good place to be, we're near the bottom of this channel here. So if the stock market takes another leg higher, it's quite possible that even in the context of this ongoing downtrend, that silver will underperform the S&P 500 for a time, as it did here. The S&P 500 has made a new high, but the confidence in terms of economic confidence, we really don't see it yet. However, we might see it soon. This is economically sensitive materials relative to defensive-oriented bonds. Exact same time period here. This is as of July 15th. As of the close last Friday, this chart has not broken out yet. In terms of this bullish breakout being more sustainable from a probability perspective, if materials can get into this white space here, that's good for the breakout holding scenario for the S&P 500. Similar situation with energy or economically sensitive energy relative to defensive bonds. While the market has gone on to make new highs, this ratio over the exact same time frame has yet to break out to the upside. These economically sensitive ratios relative to bonds look more like they're near an inflection point. If XLE or energy stocks can break out relative to bonds, you can make a case there's somewhat of an inverse head and shoulders pattern here, and a breakout might run a long way. Conversely, if this resistance holds here, there's a lot of white space below this ratio telling us Under that scenario, energy could significantly underperform bonds. Price will guide us here, and we'll be watching these charts in the days and weeks ahead. Linking back to the concept that TARP in the United States was sold as a situation where we could reset and we would learn from our mistakes, we had huge bailouts in October of 2008. If we fast forward to the present day, have we addressed the too big to fail problem? The answer is a definitive and disappointing no. This is the lengthy list of firms that would typically be considered too big to fail by the Fed. This was published by MarketWatch on June 30th, 2016. And unfortunately, too big to fail basically means that taxpayer money provides a backstop for risk takers, meaning these companies here. This chart here shows the S&P 500 from 1997, where my cursor is. This is the year 2004, and it shows us a traditional bull-bear cycle from a stock market, economic, and interest rate perspective. Typically, the Fed starts to hike rates, and eventually the economy and the financial markets roll over. They have bullets in their chamber, typically, and then they start to cut rates to stimulate, and eventually we get a new bull cycle and a new economic expansion. Under the old late cycle paradigm, some pain is allowed to take place, and during this period here, we have bankruptcies and bond defaults that are purging the system and allowing it to grow in the future. In the present day, for all of the reasons that we've talked about, the central bankers and central planners are terrified about letting something like this happen because they don't have many bullets left in their chamber, and they feel that it might be very, very difficult to stop once it starts. And that's why the Fed shifted course so quickly in 2016. Oddly enough, instead of getting a situation where we have a bull cycle, a bear cycle, and a bull cycle, and instead of waiting until some pain is inflicted upon the economy and markets to start stimulating, central bankers around the globe, including the Fed, with talk of keeping rates lower longer than they had anticipated earlier, and also talking about things like having helicopter money in their toolkit, looks as if they've decided that they're going to try to take this part of the cycle out of the equation and produce what was creatively noted on Twitter to be a bottom at a top in the stock market. It remains to be seen whether or not the Fed will be effective in terms of trying to engineer a major bottom out of a formation and situation and setup that appeared to be a major top. However, we do know their odds of success will increase if the U.S. economy can avoid a recession, and especially if the economic data out of the United States starts to improve. Also, the odds of the Fed being successful in terms of engineering a major bottom near what appeared to be a major top will be dependent upon how the market continues to view the situation in Europe. Based on the incredible amount of debt that we've covered in this video, it's probably fair to say, if we move to this side of the equation, that central banks will continue to print, buy, and attempt to prop up already elevated asset prices. The concepts covered in this video are expanded in a short takes post. If you want to find that post, you can Google this title: "What's next for central planners and their Kale Smoothie economy?" How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.